An inventoriable cost is a cost in addition to purchasing the asset that you incur, that you attach to inventory, the asset account, which means the expense isn't recognized until the item is sold later, as opposed to a period cost that we expense immediately as incurred. And I'd like to think in this example of a retailer because I saw an interesting article about two large lumber companies that were combining, and it's a $7 billion merger. And part of the reason is that they want to do business all over the country. One's in the Pacific Northwest, one's on the East Coast. And the problem is it's so expensive to ship lumber far away that it made sense for the companies to combine. They can sell all over the country and they don't have to incur nearly as many shipping costs. So shipping costs is one of these types of inventoriable costs. So let's use an example of sporting goods retailers going to buy 3,000 baseball bats and they incur $1,200 in shipping costs to get the bats from the manufacturer to their retail location. Maybe it's a warehouse. So an inventoriable cost, the $1,200 in shipping costs, is added to inventory. Logic being, you wouldn't have incurred that shipping cost if you hadn't bought the bats, if you hadn't bought the inventory. So we add it to inventory. Those costs in that asset account are only transferred to cost of goods sold when the bats are sold. Now, if it's a retailer, that's going to be gradually over time. But we have to wait for a sale before we move those dollars, the cost, out of inventory and into the expense account, cost of goods sold. A period cost, on the other hand, you expense immediately as incurred. And the classic examples are advertising and marketing costs. Reason being, we can't directly attach advertising and marketing costs to revenue, to a particular sale. So the principle of conservatism says we're just going to expense it as we incur it. So that's the difference there. So inventoriable costs, the cost is deferred into a future period. Has to do with the matching principle because when you sell those baseball bats, revenue, you're going to move the inventory costs and the shipping costs into cost of sales, and you have a better match between the revenue from the bat and the expenses from the bat. Another good example is the cost to build shelving and displays, any sort of build out in a retail location. Those costs can also be inventoriable costs. So keep in mind that inventoriable and period costs may be incurred in different periods and affect the income statement.